The broadcast is now starting. All attendees are in listen-only mode.
Good evening, everyone. Can you all see my screen and hear me? Great, thank you, James. All right, let's go ahead and get started with this week's Beginner's Circle weekly webinar. As usual, we'll start with a general overview of the S&P 500 and some of the other main market index charts that we usually cover, and use those to answer any specific Elliott wave questions that might come up. I see Deborah has a question about triangles and a possible alt count that we have in the small time frame on the S&P. Might be a good spot where we can discuss that. And then we'll jump in and talk about precious metals and the GDX, the miners, and some other things. Aurora, your question on, well, we can talk about possible short setups in the S&P, but I can't really give you specific advice on what strikes or weekly or OPEXs to use. I think that Leo Valencia offers a very robust service where he specializes particularly in looking at different option strategies and being able to run some calculations on what works best for a given theory. I know certainly if you're looking to sell credit call spreads or bear call spreads, there's with anything there's a balancing act of making sure with options time is a big factor, and Elliott wave is not designed to be specifically for a timing component. It is much more concerned with specific price levels in a pattern, although that pattern is on an X and Y axis and time is a component of that. But particularly with something where you're selling premium, the faster that erodes, the better it is for you. So getting using a shorter time period can be to your benefit, but that could also mean that if it goes against you, the effects are magnified even more so as well. Andrew says SPX, XPX.XO, SPS, $PX, etc. What? So those are all, all of us have different platforms that we use for charting, and a lot of us have different services that we subscribe to for our data feeds. So a lot of those are just different iterations of the S&P 500 index, or however the data service or charting software is displaying using that symbol. For some of us, it used to be an INX.X or things like that. Usually anything that's .x or .xo is going to denote an index chart, whereas other exchanges might denote right here a C dot or something, or a .ax might be a Canadian or an Australian name, and so forth. So the other things you might see are sometimes people might use SPY, which is one of the most popular ETFs that tracks the S&P 500. And other things that are used are ES, which is the ES mini futures contract, is the more popular of the futures contracts for the S&P 500. So all of those are almost interchangeable. Sometimes we might look more closely at smaller time frames using the ES futures contract, because it trades for more hours of the day than the S&P 500 cash does. So let's jump in and talk a little bit about where we are in the markets and what we're expecting. I'm going to zoom out here to the 3-day chart, as I've done before. And the reason why I like the 3-day chart at this point is if I scroll this over, I can just about fit most of what I expect for the primary degree wave 5. I've talked a little bit about years back, whether it was in stock waves or in the main market section of Elliott Wave Trader, about a theory that I had as far as how charts are framed, and when you start getting price action moving in price turns where the framing of a certain of a certain correction, or when you're looking at a standard chart in a standard frame of a window, like for instance a cash daily chart, for most people, the way that they're going to view this is going to cut out a lot of this prior drop. So they're not going to see this consolidation. So that's going to kind of, once that's out of the frame, then maybe it's kind of due for another version of the same. And if you jump over to like an hourly chart, you start to forget, the full version of the hourly chart kind of forgets about this entire drop from October into December that was pretty harsh and severe and was easily the start of our primary wave 4 here, which started to get to be more than just a corrective bounce that we're looking for into the end of December that I really thought should have been wider and taken the entire month to get up to back to 2500 to 2510, and then extended beyond that, and then was easily countable as a B wave, and then extended beyond that, and then we started watching it hold support for further extension to get a nominal new high here. But when you look at a regular hourly chart that a lot of traders do, to get that entire frame of, the frame of the chart, you can go back here and you see just the move off the December low. Your brain, maybe subconsciously starts to kind of forget about that previous correction. So that's right about the time where you can get something of a similar magnitude that comes again. Okay, but back to the 3-day. That's kind of a little bit academic. So we have our move off of the major bottom, which was the March 2009 low. That was a pretty major degree correction. On other charts where we have a lot of previous data going back, decades or more, this counts as a large degree fourth wave, and we have a 5-wave move up that we're counting as primary degree wave 1. And then we have our yellow Fibonacci projection. And then inside our primary wave 3 here, we can count 1, 2, 3, 4, 5 that fits very nicely with Fibonacci pinball. And that puts us looking for a primary degree wave 4 that we've talked in a few weeks ago. We had a long discussion about the ideal support levels for this primary degree wave 4 based on a lot of the guidelines that Elliott Wave gives us for fourth waves, and why this 2130 region is such a great confluence between all of those, basically 4 different guidelines for where a fourth wave should hold. So now when we zoom in, we can say, okay, we're expecting a primary degree wave 4 that should ideally come into this 2130 region. So now we want to see an ABC move at the intermediate degree, and we know that most A waves should bisect into ABC moves, and then most C waves should be 5 waves down. So that gives us a general structure that we should say at the larger degree, we should see something that looks similar to this: a parentheses A, a parentheses B, and a parentheses C. And inside that, it should be an ABC bounce, and then 1, 2, 3, 4, 5. So now that we have a framework for what that ideal structure should be, we can zoom in a little bit more and we can say, all right, we have a move off of a high that counts very nicely as a completed 5 waves up for the 5th wave of the parentheses 5 of primary wave 3 into a high probability fib target that was a nominal extension of the high that it hit back here in 2018. So if this move is the start of our primary wave 4, what does that structure look like so far? So if we know that most of our A waves tend to be ABC moves, then we're looking for an ABC move inside that parentheses A wave. And it should be pretty normal proportions. We should probably see something that has an equal move for the A and the C wave with a normal B wave bounce in the middle. So if you're trying to get that to be normal proportions, you can get to the point where you're pretty good at eyeballing, that A, B, C structure of just kind of the ideal proportions. And when we think about the Fibonacci relationship for Elliott Wave, a lot of it has to do with what looks good to the subconscious as far as the pricing, as far as the ideal. Because most people are not actually looking at charts. Most market participants are not consciously looking at charts and making decisions based on precise Fibonacci measures. They might be looking at charts, or they might just be doing a gut calculation of like their brain subconsciously of just the price movement from where they bought, and it tends to fit into those parameters. So now we can zoom in just a little bit more, that we have this ABC outlined, and we know that our A's are usually ABC moves and our C's should be a 5-wave move. But that's getting ahead of ourselves to start looking for an exact path for the C wave, let's go in smaller to this degree and focus on that A. So for that, I'm going to drop down to an hourly chart again. And so I try, when I post charts on the site and in these videos, I try, I like to leave space at the end of the chart, because we're trying to use Elliott wave not just to tell us what happened, but to use it as a predictive element for telling us what we think price has a high probability of doing. So I like to leave room on the right side of the chart. So that's why I've framed things the way I do. I want to see a little bit of previous history, and then I want to see, to give me some context so that I'm not only looking at like this. And I wanted enough detail, a small enough time frame where I have enough detail that I can see some subwave potential, but also that gives me that broader context. And so that's one of the reasons why I show a lot of different time frames sometimes when I post, that I want to show you guys and make you aware of the daily, and what that bigger picture looks like, as well as what I'm looking at the smaller degrees, and what I think we should see at the smaller degrees if things are going to continue to confirm. So now's the part where we're going to say, all right, we have a possible A wave down, we have a B wave up that hit a pretty good spot right here. This higher high inside what I think is an expanded flat for a B wave of this B, which I know that gets a little bit confusing. It's a mouthful. We have an ABC move up to here, and then we have an ABC move down for a B wave, and then we have a 5-wave move up for a C. But the highest point of that was actually here, and that was pretty close to a 618 retrace of this initial move down. So that looks pretty good for an initial A and a B wave. You'll see when we jump over and look at the NASDAQ, I could count this as one smaller degree and say maybe this is an A, a parentheses A and a B inside a slightly larger A wave here. So maybe we drop to here and get another bounce as a B wave and then come down for this A in the NASDAQ, whereas the S&P and maybe the Dow look more like this is should just stretch more towards that ideal target. So while we usually have look for an A to C, A equals C ratio for most of our C waves, we have based on where we think the A should land here, we have potential where we're looking for maybe a little bit more extension towards the 1382 extension, maybe even slightly farther than that for this C wave, if this is going to complete the A wave and leave us with normal proportions that we looked at before. So now we can say, all right, we have a possible completed B wave and we have a strong drop here. Is this drop indicative of the start of the C wave down? And well, we can apply our 5-wave Elliott wave count inside here and say, based on the proportions of the move down and the bounce back up so far to a 618 retrace, that this fits really well with our expected move down here to the 2660 to 2650 region, maybe holding a little bit higher at 2700 for more of that C wave down. But then we get into price action that we saw today, which is not exactly ideal if this is the start of the third down. It certainly fits. If we zoom in, we can get 5 waves down in the S&P and a corrective bounce out of this back up. So this is another 1, 2 inside the parentheses 3. But I kind of mentioned today on the main market service that we really should turn down pretty hard from this 2890 level. That any failure to turn down pretty hard in this 2890 level is where we need to start considering maybe that this B isn't over and maybe we're working on some sort of a triangle here. So the guidelines for a triangle are a little bit more fluid. A triangle is a corrective move. So all of the subwaves inside the triangle are also corrective moves, but it's a 5-wave move that is read as an A, B, C, D, E, and sometimes F, G, H, I, J, K, and it just continues to rattle around. Any move over, I'd say at this point, any move over 2838, 2839 in the S&P invalidates this as a triangle. So if this is in fact a triangle, though, and it's not going to hold as a 1-2 start to the C wave, then we're probably going up to test this trend line in the 2820s to 2830 region as the A, B, C, D, and the E wave of that triangle. So we'll delete that. I'm not sold on what this is. I'd rather just see us open tonight at 6 p.m. or shortly thereafter and tank pretty hard. And I think certainly a drop below 2835 really should start to accelerate and confirm the subwave count for the C wave down here. But this potential as a triangle is certainly something to consider. Really the guidelines for a triangle, you either have a contracting or an expanding triangle. So once the triangle starts to establish itself as contracting, so that means that the trend line here, this high was lower than this high, and this low was a little bit higher than this low, and this low was higher than this low. So our lines here contract. So once you have that, then this is kind of the invalidation level. That previous high is the invalidation level for the triangle, and really it should follow the contracting nature of it further, even if it's going to get more than just an E wave. If it's going to get an F, G, H, I, J, K, and however, sometimes those contracting triangles seem to go on up until price, the price window forces it to make a decision. And then usually the break, whichever way it goes, is a pretty strong move. And Elliott Wave also says that the way that it came into that triangle is that it should continue in that direction after it completes. So triangles are unique that they only happen as B waves and fourth waves. You should not get a triangle in a wave 2 position. Sometimes triangles, there's other patterns that can mimic triangles, but are really just nested setups. But really, if you do have a triangle, it should adhere to some of those guidelines. So that's how I would interpret that. If we do in fact continue a little bit higher today, and certainly, the other thing that's possible, and this is what we've talked about on the site a lot of times, is that we're trying to give you guys a lot of different analysis at different time frames for all of the different types of traders and subscribers that we have. And so what works really well for one person who's managing long only trades in a 401k that isn't doing day trades with options, they're looking to find a good entry for maybe some SDS or an inverse ETF for the market that they can hold on to for a couple of weeks, and want to just know some parameters that, okay, if it gets over, if the S&P starts to threaten 2940 to 2950, then something else might be at play, and it's time to abandon that trade setup. And so the smaller degree in here is a little bit more noise for a lot of people. So for that person that took a setup as an ABC and a high probability that we were about to start a C wave down from this 2950 region, and that maybe it could have extended a little bit higher, or maybe it could turn into a triangle, but this should still hold as resistance, and they put on a trade here, whether this is a 1-2 and a 1-2, or if that smaller 1-2 invalidates and this is just going to be an alt wider flat for this parentheses 2, is really just noise to that person. Whereas, somebody who's trading at a much smaller time frame using futures contracts, or day trading with options, whether this is going to hold 2990 and 2890 right here as a smaller degree 1-2 start to this parentheses 3, or move up just a little bit more towards the 29 12 region as an alt of this flat for the wave 2 makes a huge difference. And so that's where they need to know that, okay, this when we zoom in here, I'm going to try. I'm going to try and make this a little bit bigger. There we go. All right. So that they can see that 2889 is the exact 786 retrace. So yeah, there is another fib in between here and a 100% retrace, but 78.6 is pretty much the last stop as far as normal fibs go. We would have preferred this held the opening high at 2881 and dropped hard today. And so the fact that it didn't do that might be the first indication that this is going to try and come up here as an alt of this wave 2. And we're not dealing with this fib retrace, we're dealing with this fib retrace again. And so this higher level here, 2912 to 2916, is that higher fib level, the 786 for this move. And that could also be just the resistance as the ABC for the E wave of the triangle. And it spikes a little bit past that 2917 and then turns down hard in a restart of this wave 1 of C when just moving this B wave over. But that's kind of a good way of looking at those smaller degrees and trying to parse out and see, if you're somebody who is frequently trading, small intraday moves, then you need to become more well-versed with Elliott wave so that you can use our larger time frame charts for a broader context and start applying your own Elliott wave to those smaller degrees, so that you can take a look at those moves, and because you can't rely on us to post a 1 minute chart all throughout the day, because sometimes things change a little bit too much, or we're working on lots of other charts. All right, let's take a quick look at I think I want to look at the NASDAQ, because we mentioned the slight difference in degree. So I think the larger time frame here is we're on a 4-hour chart. You can see the December low, the same minor degree fourth wave, 5 waves up. Here in the NASDAQ, it counts best as a non-overlapping ending diagonal for that fifth, and right to the confluence of the next 2 fibs for that potential top as primary wave 3. The only difference that I see in the NASDAQ is I have this yellow potential in here where instead of the same A and B and setting up for a C wave that's going to need to extend, closer to a 1618 extension, to get to the normal proportions of where we would expect an A of that parentheses A to go, that we could be getting another circle B wave, that this could be a parentheses A, B, C in yellow inside a slightly larger version of this A, and then get another high B wave up here, and then come back down to the 6400 region as more of an initial flat for this A wave. So that's the only difference that I really see with the NASDAQ. And again, I think it's almost a little bit more academic because we're going to be following the subwave structure here. And so we'll start to notice, all right, well, if this third wave stretches a little bit below 70, 72, closer to 69, 80, as just the micro 3, then maybe, that might be the first indication that we're actually going to get closer to the 6600 region for all of this A wave in this move down, and we'll just up this degree to the circle degree and get rid of this extra layer here, or just eliminate that. So that's just a quick look at as far as trying to reconcile some different indexes that have a little bit different Fibonacci measures and magnitudes of the moves. Similar potential there off of the August 21st high is we do have the potential start to that C wave down, whichever degree it happens to be, and not the cleanest structure that we wanted to see for the smaller wave one. And so maybe we're getting a little bit more of an alt of this wave two, or some alt, even more alt structure for the B wave. ZW asks, what are recommendations for where to place stops based on charting? So a lot of that, let's go back to the S&P, because a lot of that is going to be based on degree. Kind of what we were saying, if you're that type of person who's trading in your 401k and buying an inverse ETF, for the market to trade the downside move and got in here around the 2940 region, then maybe your stop is either at this point probably that prior high, because while we could get an even more complex structure that nominally breaks that high and is still a B wave and turns down immediately, there's a good chance, when a setup is for a potential B wave top like this invalidates, the chances of getting a nominal new high over here, or at least substantially higher than this, increase dramatically. So, I think that's certainly a good level for a stop. And then, a lot of it determines based on Elliott wave, what are you trading? If you're trading this at a smaller degree, as though this is the start to the parentheses 3 down inside that C wave, well, then this 28.99 level, where that turned down from yesterday, I guess that was yesterday, as the possible start to the third, should be your stop, or at least, definitely that prior high of 29.38 in the S&P. So a lot of those, as far as the stops, and sometimes based on the way that you're trading or a position that you're using, maybe the academic level for invalidation for Elliott wave is not the same region that you should use for your stop. You have to figure out what your risk parameters are and what makes sense as far as the loss limits you're giving yourself, or drawdown limits for a particular position. And that's, figuring out how to apply Elliott wave analysis to your specific style of trading, or adapting your style of trading to Elliott wave analysis in some situations is something that there's been a lot of discussion on our site about. There's a lot of people that have written some posts, but a lot of it is kind of a personal analysis of figuring out what works the best for you. All right, there's a couple of questions here that I think maybe, they're going in reverse. Let's switch that. All right. All right, Don, I see your question about precious metals. We'll get to that very shortly. Brad, what's the exclamation mark on my charts sometimes? See, that was probably on the primary here. These exclamation marks, okay, so those are conflicts within motive wave. So for simplicity, I only have one ABC structure, ABC correction in my tools box here, and it is a flat correction. And so according to whoever programmed motive wave, they said that in a flat correction, that the B wave must retrace at least 90% of the A wave in a flat. That is not a hard and fast Elliott wave rule. We have certainly seen lots of flat, the definition of a flat structure is where you have an ABC, you have a 3-wave A wave, a 3-wave B wave, and a 5-wave C wave. And the definition of a zigzag is where you have a 5-wave A wave, a 3-wave B wave, and a 5-wave C wave. There's a guidelines for those where in the flat structure, the B wave is supposed to be higher, and in the zigzag structure, the B wave is supposed to be more muted, not getting more than 38.2%. But Garrett and I have seen those guidelines violated all over the place, especially more recently with maybe some of our algorithm-driven markets. So, we still look for normal fib retrace region for B wave. Sometimes we get an indication where, that might be only an A and we're going to get a bigger B and C wave of a larger flat. And some of that might have to do with also, if the C wave of this A stretches a lot lower, closer to, what would be our 2200, target or 2130 target region, and that still looks like only the A wave for most charts, then maybe you're going to get a higher B wave so that you still come back and target that same proportionate region. You might also see this red exclamation mark on a lot of my fourth waves because maybe I will draw something as an ending diagonal, but the fourth wave won't be overlapping the wave one, which we also don't see as a hard and fast rule. It's just a general guideline or an allowance. Or maybe something was initially an impulse, but it started to morph into a diagonal. So I did drag that fourth wave until it overlapped the wave one, and then you get another error code. So that's just motive wave stuff. And then somebody asks, their flags on the far right, what do the colors relate to? So let's see if I can make this a little bit bigger. We'll go back to the hourly chart here. So they're talking about these flags right here. The blue flag is on daily charts and all time frames under daily charts. The blue flag is going to be the 50-day moving average. The green flag is going to correspond to this green dashed line, which is the 100-day moving average. And the red one is going to correspond to the red dashed line here, which is the 200-day moving average. These other ones are the upper, middle, and lower Bollinger Band, and then this one right here, 2877, the white line right there is just current price. Richard asks, are some software packages easier to use than others? MotiveWave, I think, is probably some of the best charting software for Elliott Wave Elliotticians. It makes it very, very easy with the Elliott Wave tools. I'm not talking about auto counting because I think there's not a single program that I've ever seen that will auto count something for you correctly, because there's a lot of nuance and subjective look of things that factor into Elliott Wave, because it is kind of, there's a subconscious look that it's reading the sentiment of other people. And so something can be valid, technically valid according to Elliott Wave rules, the way that a computer program might read it, but look completely absurd to a real Elliottician. And that is a problem with the automated counting that, is something that you can do with MotiveWave, but I definitely don't recommend it. But the cool thing is that you can select here like an impulse, and you can just click, 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 and you can give yourself, a 5-wave move, and you can move that around and snap it to the different points on your chart, and you can push Control plus and increase the degree, and Control minus and reduce the degree. And you can click here and you can go to decompose and you can add in smaller degree subwaves. And so it just makes the effort of charting based on Elliott Wave and labeling your chart incredibly easy. And the nice thing there is that it standardizes the degree nomenclature as far as other Elliott Wave petitions. So you can very quickly match your charts up and know that your subwaves are going to follow a standard naming structure that's going to match what other people are using. So tremendous benefits to that. And we do offer, I think there's an offer on our site for a discount in signing up for MotiveWave, and there are a lot of different levels that they offer. The full version is pretty expensive, but I do like it. All right, I think I answered Sandeep's question about the limits for the B wave. It looks to me like the C wave should have started, or we're in that triangle. So really, it should not get over 2940 in that case. And if it does get over 2940, then maybe we're getting a much higher B wave, or maybe we're getting yet another extension of this prior move. All right. Are we now in what Dow theorists call the distribution phase of the market trade? I think so. If we zoom out again, in terms of the larger cycle, certainly in terms of this cycle for this fifth wave move, that's the fractal nature of Elliott wave. So the larger pattern that we see off of the 2009 low is not complete. We're only looking for a fourth wave consolidation into support, and then another 5-7 years of a market rally, up to substantial new highs again. But when you zoom in to the smaller degree, the fractal of the fifth wave of that third, that went through the entire sentiment cycle of 5 waves up, and now we're looking for 3 waves down. So even taken in isolation, if you had to, and there are plenty of charts that Garrett and I look at in stock waves that only started back here in 2015 or in 2016. So the only history that they have is this 5 wave move up, and they're looking for a 3 wave move down. But we might count some of those charts as a larger wave 1 and wave 2 off of the 2016 low, just because we don't have prior history to tell us that this was only a 4-5 inside a larger third, which it might end up continuing getting stuck with the market and only getting, so it only has this, and then it gets a proportional move up as a fifth, but then that's a more major top in the future. But in terms of the distribution phase, this is a more significant top looking for a pretty big 30+% consolidation back towards that ideal 2130 region. So, we should be seeing signs of distribution up here. Okay, so David says the circle A would not be part of the triangle since it's the A wave. Therefore, the low of the circle A doesn't get included. Yes. So zooming back in a little bit, if we're going to apply that triangle count, you're starting the triangle. The triangle's for this B wave. So it starts where the A wave ended. So we get A, B, C, D, and E for that triangle. And maybe F, J, K, H, element of P. Just reading through the questions. Right, okay, I knew that was related to S&P. And Richard, I think I answered your question about software and the flags. Okay, yeah, well, and then so somebody, sometimes I draw. One of the other things that I'll do on my chart is, I'll draw a line right here since we've talked about this 2940 level, which was the prior high. I'll put a yellow dashed line like that and say, all right, that's resistance. I don't know exactly what the count is going to morph to if it breaches that, but chances are it's going to go a good bit higher if that is taken out. And right now you could say any of these levels, 2853 or 2833, are temporary support levels that we really want to see broken so that we can accelerate into that pattern. Michael asks, when do we use log scale instead of normal scale? Almost all of my charts are going to be in log scale or semi-log. I think it is far more conducive to longer term Elliott wave charting, particularly the way that our markets have moved in the last several years and even in decades before that. I think when you look at a long-term chart, if you change this chart from log scale and go to arithmetic, you're getting a much more skewed look. So, for example, people that are charting the market in arithmetic scale or linear scale, are going to see the extension that this hit in linear scale, the 200%, and are going to probably, even though the subwaves don't exactly line up with that, they're going to force this top back in 2015 as the top of the primary wave 3, and this is primary wave 4, and they're going to think that this entire move here is all of a very extended blow-off top primary wave 5 that's completing, and this is even more bearish, and not going to be looking for this bigger move here because it looks kind of absurd when you look at it in linear scale. But when you convert that into log scale, it kind of smooths out this move here and the relative fib extension. And then we get, this move hit a 123.6 extension, which is very perfect based on an extended Fibonacci pinball move for this move to head up to the 1618 or the 1764, which is exactly what it did. So it kind of normalizes that move, and that difference in look between linear scale or arithmetic scale and the log or semi-log scale, it gets even more crazy when you look at a lot of individual names. All right, Richard, sorry we go fast. We try to get to a lot of topics in the webinars, but they are all recorded and are archived in the help, under the help tab on ElliottWaveTrader.net. So Victor, the Arabic numerals and Roman numerals and things are just how you denote different degrees. So at the larger degree that we have shown on our chart, 1 degree larger than this, if I were to step it up by 1 degree, then it goes to capital Roman numeral 3, which is cycle degree wave 3. And then everything else changes. But so a circle Arabic numeral is primary degree, parentheses Arabic numeral is an intermediate degree, an Arabic numeral by itself is minor degree, and then inside that, minute is going to be a lowercase Roman numeral with a circle, and then inside that, minuet is going to be parentheses lowercase Roman numeral, and then inside that, the subminuet is going to be just the lowercase Roman numeral without anything. And then it's going to start to repeat over again when you zoom in even more and go to micro degree. It'll again be an Arabic numeral with a circle around it and capital ABC letters, and that's just the nomenclature. You can find it in a Google search as far as the standardization, or it'll be in most software things, or it's in Frost and Prechter's book, The Elliott Wave Principle. Okay, Andrew asks about the blue lines, and then we'll jump over and talk about the precious metals and miners before we run out of time. These are just Fibonacci fans. I use them as similar to the Fibonacci extensions, but it's kind of provides channels that are based both on fib levels and on time. And so, you can see that sometimes they act, that if you're drawing the measure of your primary degree wave 1, that you have, one move held into certain channels here, and then once it started a bigger correction, it fell out of that, and then it followed another channel, then it fell out of it, and then it acts as support or resistance or kind of a guideline, and then it moves out behind it, and then that's resistance, and it drops to the next levels. And then again, it's below that, and so that acts as resistance for the entire move. And then once it falls more away from that, it has to go and test the next support levels. And then this larger primary degree wave 5, I think, will probably follow this line here as resistance the entire way up. I have never looked at wave basis software, so I can't give any assessment there. All right, let's move on and take a look at gold itself, and then we'll take a look at the miners. No, is this it? Yeah, okay, that's it. All right, so at the larger degree, off of the December 2015 low, we have a strong initial move that we're counting as a 5-wave up impulse for primary degree wave 1 and a retrace here. This low is what gets a little bit confusing. We can get an awkward leading diagonal for an intermediate degree wave 1 and wave 2 because it didn't make another low under here. But the miners did, and silver certainly did. So the miners and silver count as an A, B, C, or maybe a WXY for some of them. But with this low in late 2018 being the primary degree wave 2 low. So there's a little bit of a discrepancy there. It certainly would be valid to count that here too. and this is a little bit more ahead of or further behind, but I think that we were looking for consolidation once we got into the 1460 region to come back, and counting this as the wave one and 1, 2, 3, 4, 5 up off of the 2018 low. And it did not get that consolidation. It instead held a much higher consolidation and has extended through other regions of resistance. So I think we can still be in a mode where we can start to see some consolidations in gold, at least moving sideways and testing, the high 1400s as support, before, and then inching, setting a series of sideways consolidations with nominal higher highs, until we get to a little bit wider consolidation. And I think that can still fit with the consolidation that we expect that might be a little bit deeper than such a high flat consolidation in gold in the minors. But I do think that gold looks like it has finally broken past all of the different resistance levels that we were looking at for to hold it back as a smaller degree wave twos. And so now we should be continuing up substantially higher in more of our primary degree wave 3, which is easily targeting close to a nominal new high over 2011. But could be a pretty choppy road in the short term, just going back and forth, which might be great for shorter term traders, but for people looking for this to get immediate crazy extension heading towards 2000, there might be some sideways movement to slow it down. The other thing that Garrett and I are starting to be a little bit concerned about based on the price structure is that this might have been an A wave, and this is a B wave, and this is 1, 2, and then 3 of a diagonal. We get a fourth and a fifth wave that's completing a larger degree B wave that will set up for more of a flat consolidation, instead of this being all of the wave 2 or the wave 4 in the 2015 low, that we're going to get more of a flat where this is an A, this is a B wave, and we come back down to test that 1,000 to 1,100 region as an orange C wave out into the future. Maybe that's because we're getting the primary wave 5 in the markets. If we were going to look at maybe some correlation, not that these things are directly correlated, but that there's money that has to flow from out of one thing and into another sometimes. And so what could fuel a big equity rally? Well, maybe all of those people that did really well, off of the 12 and 1300s, up towards 1800 and 2000 for a possible B wave, decide to take some of that profit out and put it into equities. So when we're looking at small levels of the consolidation level, we really want to see any consolidation should really hold the high 1400s, maybe 1450 to 1475, really should be support for any of these smaller degree wave 4s and increasingly larger degree wave 4s until we start to advance up towards the 1800. So any break of that region, and we have to start worrying that any top in here could be the top of this orange wave 3, which ideally would get another 4-5 if that were the case. But that could come back and test into the 1300 region of support. So we've talked to some. Jatinder Pal asks about what we would expect, and that goes back to the equity markets after the even larger primary wave 5 completes. I think it's very academic at this point. It's not related to our trading now. We've had some discussions on the site, and that's something that maybe we can cover and take a look at a little bit next week. I want to move on and jump to GDX before we run out of time. All right, let's go to the big macro clean tab again. Similar to gold, we have that strong move that we're counting as primary degree wave 1 up, but as we discussed, we have this WXY consolidation into the September low for its primary wave 2. So it's running behind gold substantially, both in relative price movement, but also in just in terms of where it is in the count. And we strongly think that gold is still within a region of being only the intermediate degree wave 1 of what we expect for this larger primary degree wave 3, which is easily targeting, up here into the 64 to 80 region for the primary wave 3, and maybe even stretches beyond that. And then the 4-5 beyond that easily gets GDX well over 100. And certainly if this is all still part of that intermediate degree wave 1, which is just now touching the 618 extension, which is the further extension that we expect in a normal Fibonacci pinball for wave 1, which is why Garrett and I have these this potential count where this is all of wave 1 completing, but maybe as an ABC up. And so this isn't a primary wave 3, but a primary wave C. Still very, very bullish longer term. But after that, hitting the 60s to 60 to maybe 80 region at that point, it would possibly not hold a fourth wave at that point and turn down stronger. But in the meantime, we would like to see a fourth wave consolidation. So this move up got us to the 31 region, which is the next fib extension from the 1236 that we were looking at for our third wave here. So both of those are very valid extensions in a diagonal. Probably looking for our fourth wave to hold a little bit higher now and maybe not break under the 25 region. But we do want to see a nice ABC consolidation that sets up for another high probability move for the fifth wave of that diagonal. And the potential that we see for a larger wave 2 to be starting would overlap that structure. So the same ABC for a fourth could be just the A wave of this wider flat. And so instead of getting a fifth wave up to new highs, it might just get a big B wave and then a C wave down in a wider flat there, if that's the case. Our thinking here is that, we were very bullish in May, saying we weren't clear. It wasn't clear if this was a fourth and we were only going to get a fifth wave up in a smaller version of this diagonal, or if this was a wave 1 and a wave 2 and we were going to get a stronger move up as the third in this bigger leading diagonal. We weren't clear which one it was, but we did know that off of the February high, that people also didn't believe us could have been any kind of a local top, that we had a very clear ABC structure into a high probability fib support region that made for a very, very bullish structure. So, we trimmed into some of these gains here and have reduced our exposure to miners and increased our cash position so that once we see, even if it's a shallow consolidation at this point, but once we see a clear consolidation into support, then we can add back for the next advance. But there's enough that we're a little bit concerned about some of the structures here, particularly that maybe this holds as a wider flat for the wave 2, but there are some names that got a little bit more aggressive than they should have here, but the structure still looks very much like only 3 waves. And so the fade back could be pretty harsh. So we're trying to avoid that. If this were to all of a sudden start to accelerate more, we still have a lot of exposure in our model portfolio in the mining stock service, and we would have names that we'd consider adding and ramping up to, and there's a lot of room to the upside from there. So, if the structure and character of this move were to all of a sudden start to change, maybe we're at reduced exposure for a few points here that we miss out on, but, we would quickly ramp that back up. But it's much easier for us to add things that are clearly breaking out than to try and panic sell when support starts to break. We would much rather sell into strength, which is exactly what we did back here in January and February as well. Andrew says, why are there yellow fib fan lines with a downward slope on this chart? So I have that. That was on the gold chart, and also here on GDX. And so what I do, similar to how I use the blue ones a lot of times, or green ones, for the initial move in an impulse, or for the, to look for where possible support levels are for an A, B, and a C, and another B and a C wave down, and then even more, falling outside of that, for a larger correction. And then, this probably isn't so applicable anymore because maybe it's going to follow this final fan line here, but I don't think we're not getting back up to this region at all anytime soon. So, maybe we should draw a new one and look at the projection off of here, or certainly at one off of the intermediate degree. But at times I'll also draw one for a previous larger correction. So this is this larger ABC at the primary degree, which counts as a cycle degree wave 1 and wave 2, or a cycle degree 3 and wave 4 in a lot of charts in the mining stocks, or in gold. And so this gives me reference points of possible residual resistance, and once something is taken out as resistance, then it can also act as support. So if we go back here to the gold chart, because I think it was a little bit cleaner here, the way I was illustrating it, is that we had this fan line here that I highlighted with the yellow, brighter yellow segment, acted as resistance for a long time, and we fell away, came back up in resistance again, fell away, then resistance, and then we finally broke over it back here in August 2017. And then from that point on, it provided support. We went up to test the next one. It was resistance. Then we went up to test it again. Resistance, came back this one again as support here. And then we finally break over it. And then we come back and contest it again and acts as support. So once, this was acting as resistance initially, we broke through it. Then it was tested as support, broke through that one, now it's being tested as possible support. So right now, that's why I said, any of these fourth waves, if we're further along inside the impulsive part of this count, this region of these support lines, that fits both from a Fibonacci pinball standpoint of where, these subwaves should hold based on, our Fibonacci pinball at the different degrees, but also from that fan analysis. So going back to the GDX chart, for any immediate further extension, I think you really need to look at this 2930 region as immediate support. So here's the more recent low that looked like we had a possible start to an A and a B of this A wave, or maybe an alt B wave of this A wave. And so now that we got 1, 2, 3, 4, 5 up, or maybe this is 1, 2, 3, and it needs a 4 and a 5, that 2930 region is what really needs to hold to get further immediate extension higher, in stretching this 3 even more, maybe to 3330. So that would be the first indication of possible break of some support for more of this A wave. But I do think that this is going to test the highs in the 30-31 region again as a B wave, and maybe even another B here. And so it's going to cling to this region for a while before you get kind of just that C wave down towards 24-25 to test support from the 100-day moving average, the trend line from the diagonal, and then head back up for the fifth wave. Not exactly sure what your next question is, because miners are not performing the way they should, like extensions. I mean, some of the individual miners are doing just fine, and I think, Garrett and I might be counting GDX differently than the way Avi's looking at it, and a lot of that is colored by the way that we see 100+ different individual names that we look at on a regular basis in the mining stock service. And so, we have at times looked at something like TXGM, which is a Canadian index of miners that has more components and a much different weighting than what GDX looks like. And this was one of the things that back here in late 2018 we were able to be incredibly bullish, because even though people were starting to doubt how bullish the miners were, because something like this was more representative of the larger structure that we were seeing, is a lot of other names that were still looking like just a big wide ABC flat for primary wave 2 that were not nearly as bearish as GDX itself looked, or the Huey, or some of the names that were dipping down to new lows. And here it's not clear if this is intermediate wave 1 or if this is 1, 2, 3, 4, 5, and this is intermediate wave 1. Looks like we might be starting the B wave here in a wider flat for the wave 2, but could get a deeper fade here. And sometimes TXGM seems to run ahead of what GDX is doing, because some of those individual smaller miners that don't make it into the GDX's portfolio, or are such a small position in GDX they don't have a big effect, are sometimes a lot of leading indicators for what the big boys are going to do. Bo, as far as the fib fan lines, I use the starting point for that wave 1 and the end point for the wave 1, for it in most degrees. Like that's what I'm using, for the most part. Or if I think of a larger 5 up is completed that might turn into a wave 1, that's what I'm doing. But that kind of gives me a guide both for levels for the ABC for the bigger wave 2, and then channels that it can follow along the way. So I think I have done webinars in the past on the fib fans, but maybe I keep saying it, I need to do another one that's solely based on using them, because I do think they can be a good tool. For me, it helps as an added visualization tool for seeing Fibonacci pinball in action, and just kind of how, and gives it another possible element to timing component and different levels for support. All right, well, we did go to our normal 6 o'clock. Quick look at TLT, because I know that's something that's usually requested. I'm going to go to one of my other tabs here that is cleaner. So the way that we were holding support back here into the 2018 high looked like TLT might have been a larger cycle degree wave 4 and setting up for a 5th wave move higher. Because we are getting to a nominal new high, it's even possible that this is completing all of the cycle wave 5 here. But I do think that this is just an exaggerated extension of the 5th of this C wave of the primary A. But it's certainly possible that we get more of a sideways consolidation. Maybe it does have to walk back some of this exaggerated move, but I wouldn't be looking at TLT as a clear short setup yet for what should be just a B wave, because this can certainly extend even more, and maybe this is already the primary degree C wave of this cycle 5. And so I've been kind of looking at TLT. I was very bullish a while back, and now I'm kind of agnostic while I wait for maybe an initial move off of the high. I've been following the subwaves in treasury yields on the TNX chart a little bit more closely, and really think that this 5th wave extended nicely as I was thinking that it could. But we can certainly count 5 waves completing inside that 5th as well. So it could end up accelerating more and be more aggressive as if the market breaks down and people decide to put all of that money into safety. But I think this is not something that is directly correlated with the market recently, and it's something that we like to joke about a little bit, that plenty of times the market was dropping and people said it was because rates were going up, and other times the market was dropping and people said it was because rates were going down. So certainly, as we mentioned with gold and the miners, that there are flows of capital that we're aware of, but it's not always in direct inverse correlation to other parts of the market. So I am looking for a B wave consolidation. That doesn't necessarily have to be such a high bounce. It could be, it could be a really, really slow start that just kind of drags sideways on yields and keeps yields really low for a while, and then all of a sudden pops up in a C wave, and then it starts to reverse almost immediately. So the ups and down movement, however, even if they're smaller magnitude, might certainly have some kind of inverse correlation with the market. But there's, right now I'm just looking for some of those early signs that some part of this B wave bounce might be starting. And until then, this can certainly extend a little bit more, so it does not seem like a good spot to start shorting TLT with abandon. But if you had been long and we were looking at setups for a pretty substantial C wave higher, we've met all of our targets for that and exceeded a number of those targets. So certainly a good time to have some trailing stops and start looking for the exits. All right, well, we can always answer other questions on the site, but it's been fun, and I'll get this uploaded and for you guys, and so it'll be in the archive, and we'll see you next week. Have a very good evening.